Hello everyone. Welcome to my Workbook Solutions video for Managerial Accounting. We'll start off with Chapter 16, our introductory chapter. Please note that if you're watching this video at a much later date than it was posted, the chapter number may have changed as well as the page number of each example in your workbook. Overall, that shouldn't matter as the example problems we'll work through will still work for the purposes of explaining the material. I'll also show the question in its entirety within the presentation, so you won't actually need a physical copy of the workbook, though having one will make the process much easier. Without further ado, let's begin. First, a quick review of our cost classifications. Remember that we can categorize costs based upon where they occur. Within our manufacturing facility, we have our production costs, the cost of making our own inventory. Our three types of production costs include direct materials, direct labor, and factory overhead. Direct materials and direct labor are directly traceable to individual cost objects, whereas factory overhead either cannot be traced or cannot be easily traced. We can further group these costs as prime costs for our direct materials and direct labor. Remember that prime basically means direct. And conversion costs for our direct labor and overhead. Conversion costs are the costs we apply to our materials to transform them into inventory. These three costs are capitalized into our inventory accounts as they are incurred, and they will ultimately be expensed as cost of goods sold upon their sale. The costs we incur in our corporate office and retail space are our period costs. Rather than being capitalized into work in process and finished goods inventory, these are simply expensed as incurred. Period costs are generally categorized as G&A for those like IT, HR, legal, and accounting, and selling for items like advertising, marketing, and sales staff salaries. If you'll turn to page 7 of your workbook as of the publishing of this video, you'll find a table with the following items and amounts. Your book presents it as one large table, but I've broken it into two to show its entirety on one slide. For each of these items, let's classify it as either product or period. If it's a product cost, let's further classify it as direct materials, direct labor, or factory overhead. If it's a period cost, let's categorize it as either selling or general and administrative. Starting with advertising expense, that is a period cost. Is it selling or G&A? It is a selling cost. What about depreciation expense on office equipment? That is also a period cost, and it is G&A. What about depreciation expense on selling equipment? That is also period, but it is selling. How about depreciation expense on factory equipment? Because this cost occurred in the factory, it is a product cost, and since it cannot be traced to an individual item, it is overhead. Factory supervision, product, and factory overhead again. Factory supplies used. I should perhaps clarify that we're referring to general supplies. These are product and factory overhead. Factory utilities, product, and factory overhead. Direct labor, product, and direct labor. That one was easy. What about indirect labor? Product and factory overhead. Miscellaneous production costs. Product and factory overhead. Office salaries expense. Period and G&A. Raw materials expense. Product and direct materials. Rent expense on the office space. Period and G&A. Rent expense on the sales space. Period and selling. Rent expense on the factory building. Product and factory overhead. Maintenance expense on factory equipment, product and factory overhead, sales, not applicable. Sales is a revenue item, not a cost. Finally, sales salaries expense, period, and selling. Flip over one page to your right to page 9. Here we find the following information for Superior Manufacturing Company. Let's build a cost of manufacturing statement and an income statement. Presume a 25% income tax. All raw materials were used as direct materials, and factory overhead was totaled on a separate schedule. If you don't have the workbook, I recommend pausing this video and copying down this information to reference as I build the statements on the upcoming slides. Really, I'd recommend trying to build the cost of manufacturing statement on your own, then watching the solution, but barring that, at least be sure you can reference this information as I build these two statements. Our basic formula for determining cost of goods manufactured is to start with beginning work in process inventory and add manufacturing cost for the period to get our total cost in work in process inventory. Subtract the ending work in process inventory from that sum, and we have our cost of goods manufactured. Look back at our account balances, and pertinent to that formula, we see our beginning and ending work in process inventory amounts. I recommend you also check these amounts off as we build these statements. With those two amounts established, we only need to determine our manufacturing cost for the period. From that number, we can determine our total cost of work in process inventory and then our cost of goods manufactured. Our manufacturing cost consists of our raw materials, direct labor, and factory overhead. We know our labor and overhead. Again, we can find those two items among our balances. If we look for raw materials used, we won't find a single account communicating that information. We'll have to use these three accounts to determine that amount. To determine our raw materials, we'll use the same formula we're using to figure out our cost of goods manufactured, just with some terminology swaps. Start with beginning raw materials inventory. Add our purchases for the period to get total raw materials available for use. Subtract our ending raw materials inventory, and we now have raw materials used. We can now fill in these unknown amounts. Raw materials plus direct labor plus overhead yields total manufacturing costs of $430,000. Combine that number with our beginning work in process inventory, and the total cost of that inventory is $480,000. Subtract out our ending work in process inventory, and total cost of goods manufactured is $400,000. We've now used all our necessary accounts for determining cost of goods manufactured. Those remaining accounts can be used in building the income statement. If you're taking my class, I don't care so much about your ability to create an income statement, but I do want you to follow how cost of goods sold is calculated using your finished goods accounts. Our format for the income statement is unchanged. List our sales, then subtract our cost of goods sold to arrive at gross profit. From our gross profit, we'll subtract our operating expenses, which consists of administrative and selling expenses. Subtract that $90,000 from our gross profit to get operating income. 25% of operating income is our income tax expense, which after subtracting will provide our net income. Just like with the cost of goods manufactured schedule, we only need one amount to calculate the rest of the figures. We've made use of our sales, selling, and administrative expense balances. We can now use our finished goods balances to determine cost of goods sold. Start with beginning finished goods inventory and add cost of goods manufactured to get cost of goods available for sale. Your cost of goods manufactured amount came directly from the cost of goods manufactured schedule we previously prepared. Subtract the ending finished goods inventory from that sum to get our cost of goods sold. We can then calculate our gross profit as $150,000, operating income as $60,000, income tax expense as $15,000, and net income as $45,000. Turn to page 10 of your workbook where you'll find the information for the Lacagas Corporation. If you don't have the workbook, pause this video and see if you can build a cost of goods manufactured schedule and an income statement. Again, I don't care so much about the income statement, but try building a partial statement that shows gross profit. We can start by identifying which statement each account pertains to. Of our inventory balances, raw materials and work in process will be on the cost of goods manufactured schedule, while finished goods will be on the income statement. Advertising expense, income statement. Depreciation on office equipment, income statement. Depreciation on factory equipment, the manufacturing schedule. Direct labor, manufacturing. Utilities, manufacturing. Indirect labor, manufacturing. Materials purchased, manufacturing again. Office salaries, that's on the income statement. Factory property taxes, manufacturing. Office building property taxes, the income statement. Factory rent expense, the manufacturing schedule. Sales, the income statement. Sales salaries, the income statement. Factory supplies and factory miscellaneous costs. Those are both on our manufacturing schedule. With our relevant accounts identified, we can start building our cost of goods manufactured schedule. As in the last example, we start off with our basic formula for determining cost of goods manufactured. Beginning work in process inventory plus manufacturing costs equals total cost of work in process inventory. Subtract out ending work in process inventory, and we have cost of goods manufactured. Of these particular items, we only have the amounts for beginning and ending work in process inventory. We need to determine manufacturing costs to determine the rest. Our manufacturing cost consists of direct materials, direct labor, and overhead. To get our materials used, we start with beginning materials inventory and add materials purchases to get total materials available for use. Deduct ending materials inventory, and our materials used is $644,500. Direct labor is $1,245,700. Factory overhead is the sum of a few specific accounts. Looking back at our company information, we can identify the following accounts as overhead. Most schedules would list these items individually, then show their sum. But since space is at a premium on these slides, I'm just going to put these items total of $380,700. We can now determine the total production cost as $2,270,900. Combine that amount with beginning work in process inventory to get total cost of work in process inventory. Then subtract any work in process inventory to get cost of goods manufactured. Now we turn our attention to the income statement items. On our income statement, I just wanted you to determine gross profit. As usual, take your sales, subtract cost of goods sold, and you have gross profit. To get our cost of goods sold, take the beginning finished goods inventory balance and add to it the cost of goods manufactured. Again, this amount comes from the schedule we just prepared. Those two numbers combined give cost of goods available for sale, from which we deduct the ending finished goods inventory to get cost of goods sold. We can now determine our gross profit of $2,105,700. If you wanted to finish the income statement in this example, you would then list your remaining expenses as operating expenses and subtract their total to arrive at operating income. That concludes this video. If there are any problems from the workbook I didn't cover, you can find their solutions in the course module on Blackboard. Please let me know if you have any questions. Thank you for watching.